Today, we're diving into the single most important document in the world of high-stakes private investment. This thing? It's the key that unlocks deals worth millions, sometimes even billions of dollars.
Have you ever wondered what's going on behind the curtain? When a fund wants to raise a massive amount of cash from private investors, they can't just shoot out an email. No, there's a super formal, incredibly detailed process, and it all revolves around one crucial document.
And here it is, the Private Placement Memorandum, or PPM for short. Think of it as the master key that unlocks the deal. It's this dense legal document, and its whole purpose is to give a sophisticated investor absolutely everything they need to know before they write a very large check.
So here's the thing about a PPM. It's always being pulled in two directions. On the one hand, for the investor, it's a user manual. It's supposed to lay everything out, warts and all. But for the fund manager, it's also a legal shield. Every single word in there is chosen carefully, not just to inform you, but to protect them if things go sideways. And that tension, that's the key to really understanding this thing.
Okay, so let's take a quick tour through a typical PPM. We're going to start with the one section you absolutely positively cannot skip. This is where the fund tells you everything, and I mean everything, that could possibly go wrong.
And what's really telling is where you usually find this section. The risk factors, they're almost always right up front. And that is completely intentional. Before they even start selling you on the dream, securities laws demand that they are crystal clear about the nightmare. You have to go into this deal with your eyes wide open.
And trust me, they get specific. They'll cover the big stuff, market risks, like an economic crash. They'll get into operational risks, like what if a key person quits? And they'll even outline risks tied directly to their specific plan, like an industry getting hit with new regulations. The goal here is just total, unvarnished disclosure.
All right, so once you've waded through all the warnings, it's time to get to the good stuff, the potential upside. This next section is really the heart of the PPM. It's where the fund manager lays out their grand vision, their game plan for how they're going to make it all work.
This whole section basically tells the story of the investment. It starts with the executive summary, that's the quick, high-level pitch. Then you get the investment strategy, which dives deep into the playbook, the how they're going to do it. And finally, the use of proceeds gives you a transparent breakdown of exactly where every single dollar is supposed to go.
And detail here is everything. A PPM isn't just going to say, we buy companies. No way. It's going to get super granular, something like this. We execute leverage buyouts of mid-market companies in a specific sector. And that level of detail isn't just for show. It legally locks them in. It tells investors exactly what they are, and just as importantly, what they are not signing up for.
Okay, you know the risks, you know the plan. Now it's time for the nitty-gritty, the rules of the game. This section lays out all the specific financial and legal terms of your investment. This is the fine print.
So this table breaks down the big ones. The minimum investment? Well, that's your ticket price to get in the door. The management fee is what you pay every year, usually a percentage just to keep the lights on and the managers paid. Now, carried interest, or carry, this is the big one. That's the fund manager's cut of the profits. It's their main incentive to knock it out of the park. And finally, eligibility. This is about whether you can even play, which often means you have to be an accredited investor. That's a fancy term for someone with a high net worth who the regulators think is sophisticated enough to handle these kinds of risks.
So we've covered the risks, the plan, and the rules. But, a brilliant plan is pretty useless if you don't have the right people to actually pull it off. And that brings us to what many pros would argue is the most important section of the entire document.
Yeah, it really boils down to this idea. You could have the most perfect strategy on paper, but at the end of the day, private investing is a bet on people. Do you trust this team to navigate a crisis? Do they have a real history of success? This is where you decide if you trust the jockey, not just the horse.
So how do you evaluate them? Well, you get their detailed biographies, their resumes, their backgrounds, where they came from. But honestly, what's even more important is their track record. What have they actually done before? Where did they succeed? For a fund manager, past performance is a huge selling point because it shows they've been in the trenches and won before.
So we've walked through this entire beast of a document. Let's just zoom out and boil it all down to the absolute essentials. What is this thing really telling you?
When you strip it all away, a PPM is really just answering these 4 questions. It moves from the defense to the offense, from what could go wrong to the plan for what could go right. It balances the hard rules of the deal with the soft skills of the people in charge. If you can get solid answers to these 4 questions, you basically understand the investment.
Which leaves us with one last question about what a PPM truly is. Because it's trying to do two things at once, sell you a vision and warn you about every possible disaster, is it ultimately a blueprint for success? Or is it really just a carefully built legal shield against failure? The real answer, of course, is that it's both. Something to think about.